All right, recording has started. This is Brian Wilson, Market Structure Edge, February 5th. I hope you guys are all doing well. Letting a couple of other people back or into the meeting here. Just a couple of thoughts in terms of today's meeting. Most of you are very familiar with this, but if you could just mute yourself, please, during the course of the meeting, that would be very helpful. Please enter any questions that you want to up on the chat line up on top, and I think that's really it. So we'll unpack where we're at right now. It's obviously a little bit of a dicey period, and we'll try to see what the data is showing us right now. Betsy Candace, yeah, new background every week. That's actually from Microsoft. So Microsoft provides me with the background updates there, and I appreciate it. They had one of a sunrise yesterday, and it was just spectacular. So I do love getting out in nature, though. My family and I we do a lot of hiking, decent amount of camping as well. Well, let's go ahead and get started, and I'll start with a headline that I read earlier today, where the Nasdaq is on pace for its worst 3-day slide since April. Okay, well, headlines are obviously they're there for a purpose. They get our attention. But when I was thinking about that, if it's the worst since April, what did April look like? So let's begin by looking at that, kind of comparing it to where we're at right now. Of course, we remember back in April, that was, I can show you here on the dashboard. It's probably easier. And I'll need to back this up about a year. It's amazing. It's already almost a year since that has taken place. So the market was very, very choppy. What you're looking at here in green, once again, is market structure sentiment. That's our demand algorithm. Up above is SPY, and down below here is short volume. So what we experienced coming into the April drama that this headline was talking about, the market had been moving a little bit lower. It had been a little bit of a difficult start to the year, and I'll have to move that back further to show you what that looked like. So this was the start to the year. It was kind of choppy at the beginning of the year. Started moving lower into the end of March, and then we really moved lower there in the early part of April. What did our data look like then? What does our data look like now? And what I'll share with you, just a couple of data points to consider here. One is, and what you're looking at, this is just an internal spreadsheet that I keep. It helps me to keep track of trends over time. What you're looking at here is the beginning of April. Here's where the tariff tumult or the tariff drama really kicked in. Obviously, huge declines there for a period of time, huge advances a few days later as well. But what I wanted to share with you is and this really started at a transition period. We went from the end of March into early April. The market was actually pretty strong at that particular time. Look at sentiments across the market at 6.1. It started to deteriorate very rapidly. You can see that trend where broad market sentiment deteriorated all the way down to 2.1. From a big tech perspective, it was also very strong at the end of March. That also started to deteriorate pretty rapidly. That big tech sentiment got all the way down to 1. Obviously, you can't get any lower than that for a whole portfolio. To be down to 1, that shows you the type of pressure that we had been experiencing. So that being said, April trading, let's call it roughly around neutral when we started to deteriorate. Big tech sentiment perhaps a little bit lower than that, but you can see big tech really took it on the chin very, very rapidly. So let's fast forward to where we're at right now. And once again, keep in mind some of these declines, they were made made much worse by, the news that was out there. But here's where we're at right now. I haven't been able to fill in the data yet for today, but you can see from a big picture perspective, it's just been a very slow move lower in terms of broad market sentiment. Uh, Big tech was actually moving a little bit higher. That also is just starting to slowly move lower. What's been happening from a broad market perspective? Well, for the last 4 days, we're down, 1.25%. So we've been moving lower, but we've been, kind of making up some of those losses towards the latter part of the day. You've heard us talk about 0 day to expirations. I think that is playing into some of that activity that we're seeing. How do we compare to last April? Well, I mean, we're much better right now. What does that mean then? Well, I mean, a couple things to me. If the market continues to deteriorate, we have a long way to go. So, in other words, if we do see a little bit of a risk off posture for a little while, sentiment is at 5 right now. Big tech is at 5. So if we do get that downside that starts to accelerate here, this could last a little while longer. Once again, moving back to last April to show you what that looked like, and that was obviously very, very rapid in terms of those declines. Sorry, went past it. But that took about 2 weeks, for us to move lower and then for big tech to kind of move back up to 5. And once big tech moved back up to 5, you can see down here the market started to stabilize a little bit. It was still, we still had a couple of days that were kind of rough, but from an overall perspective, we started to get some stabilization. But once again, that was about a 2 week time frame, really made worse by headlines. Are we getting any headline risk right now? Well, tech sell-off. Otherwise it's been, just kind of one thing after another. And Tim wrote about this a couple of days ago. They called it rolling crashes. You think about healthcare and silver, Bitcoin, software, gold, Microsoft, AMD. I'm probably missing something. I have a number of companies, software companies on the investor relations side of things. They are just getting absolutely destroyed. It's been a terrible pricing environment. Are these canaries in the coal mine? Possibly. There's been a lot of them out there. That being said, let's go take a peek at what we're seeing year to date. And I mentioned this in this morning's note. So if we look at year to date performance, S&P 500 54 basis points through yesterday. I believe that's through yesterday. But you look at some of these sectors, there's a lot of really good returns there. A lot of the companies, IR companies that I help to support, they're doing great so far this year. Other ones that fall into the tech space, not so great. And once again, as you're very familiar, the S&P 500 is very heavily slanted towards tech. And I think I wrote about it this morning. Small cap, mid cap, I believe that number was 5.8%. Year to date gains are roughly about the same. Really strong gains, year to date. Meanwhile, S&P 500 is struggling because money is been coming out of some of the big boys. So that's where we're at right now. So far, it's been okay year to date. This is what we're looking at today. Consumer staples up 26 basis points. Some of the high flyers that have been doing really well, not doing as great. Materials, has done tremendously so far this year. That's more of a risk off posture today. What does that mean? Tech continues to suffer, financials suffering, energy, which has been a high flyer, suffering today as well. So are we beginning to get a little bit of that risk off? It's hard to say. I mean, today's not a great day, but let's take a quick peek at how that average pricing works across the market, and you can see it playing out a little bit. You get weakness during the early part of the day. What tends to happen, you tend to move back towards midpoint pricing. You get some more weakness, it moves back towards the midpoint. Why is it doing that? Well, in general terms, in those who get on these calls all the time, this, the SPY tends to move about 1% on a given trading day. The underlying stocks for the S&P 500 tend to move about 2%. There's an arbitrage opportunity in between them, but whenever you see days where the S&P is down 1.4, 1.5, what have you, and if there's not really any news like the tariff drama or what have you, if there's no real news attached to it, a lot of times you'll get this recovery that'll move it back towards the average over time. Speaking of that recovery, let me show you a slide here. And I was working, this is actually a whole slide deck that we put together more for a marketing perspective. And I'm not going to share all these slides, but I'll just show you what some of these slides are. If you're interested in this slide deck in terms of helping you to understand the market, how it works, where we used to be, where we are now. You've seen some of these slides before over time. Just let me know. I'll be happy to pass this along. What I wanted to show you today is I wanted to share this slide with you, and we could actually add one with those 0 day to expirations activity. But the whole market tends to encourage averages. Part of that is because of what's called regulation in NMS that requires stocks to trade between the best bid and the offer. What does that get us? That gets us the average. What do passive investors try to do? They try to track averages. That's between the best bid and the offer, average pricing. You only have a few big brokers anymore that are executing trades. They're fined if they aren't consistently between the best bid and offer. What does that produce? It produces the average. You have 0 days to execution options. If we were adding a slide to this, what does that tend to do? It tends to drag things, back towards the average. On a slightly longer term, you have quant fund strategies or hedge fund strategies. If a peer gets above their peers, what's going to happen at some point? They're probably going to get dragged back down towards average pricing. Or if you're an underperformer, what's likely to happen? You'll probably get dragged back up towards average pricing. But we have this whole dynamic in the market that encourages averages. So let me stop there for a second, see if there's any questions that have come in. Question. I'll start with Joe's question here. Has anyone gotten the dashboard updated? I still don't have yesterday's data. We're still missing that, Joe. My apologies for that. At the beginning of the call, I mentioned that our engineer pulled an all-nighter trying to get that updated, and he's still at work. So it must have been an issue that was much more complicated than I thought it was early this morning. So our apologies for not having that data for you. It kills us internally when we don't have that data. So we feel very, very bad about that. Question from Brad: Does Edge have any data or metrics for something like market breadth? It feels odd that sentiment is still at 5 when you see how much certain names are moving down. And Brad, not necessarily market breadth, but if you look at and you can see why sentiment is still at 5, I think, because of what's been happening in the background. If you look at all of the sectors that are performing, so well year to date, that's going to have sentiment moving higher over time. But here's a consideration, and I think I mentioned this in this morning's note, and I'm not sharing. Sorry about that, guys. I do that once in a while. I caught myself this time. This was what I was getting at. So we have so many sectors that are still doing, so well. That's why sentiment has done pretty well to this point. But if we look at some of those sectors, and I think I have them listed here. Let's go to a few of those, and I mentioned them in this morning's note. At one point, they were higher, and they're starting to fade a little bit. We look at consumer staples. Consumer staples a couple weeks ago was all the way up to 8. That's the type of strength that was, giving these sectors, this really good performance. Consumer staples now down as of, well, it looks like it just updated, guys. So look at that. So as of 2/4, consumer staples now at 6. Let's look at energy, and I'm happy that we got an update there. So energy, you can see it was 8.2, and energy is at 7.6. So energy is still, very, very strong. We look at materials. Materials is fading. Uh, and maybe that's part of the reason that we're getting today's weakness. I'm not sure, but all the way up to 8.7, 8.7 on the 20th, and then as of yesterday, down to 5.2. Two more of the high flyers here. Industrials at 8.1, once again, about a week and a half ago, and industrials, now down to, what is that, 4.9. So it's moved below neutral. So we have a lot of these high flyers that are starting to move down to that neutral range. And then healthcare similar, 6.2, and then that's moved down to 5.1. Let me do one thing in the background, guys, and I just found out that we got the data. So let me take a peek and see what our daily read is. So we have a daily sentiment read, and we have the 5-day read. And that daily sentiment read is still just kind of treading water. It's very interesting. We're not getting the rapid deterioration yet. The 5-day read at 5.2, and you can now see what that looks like. So sentiment, just continuing to move slowly lower, and that hasn't updated yet. But where we are at 5.2. Let me see if I can get an update on this. Okay, the system must be in the process of updating. I see it for individual names, but I'm not seeing it for broad market sentiment yet. But the point I was trying to make is, we have had certain sectors, certain plays that have been very, very strong. They are starting to deteriorate a little bit now. Is that perhaps a little bit of a canary in the coal mine as well? I mentioned this morning from a big tech perspective, and this was a good just reminder for me. What I did is I had our big tech portfolio, and then I sorted it by demand trend. Let me sort it the other way. And I was looking specifically for sentiment that was up. And I mentioned Apple in this morning's note, and I also mentioned Meta because it was topped at 10. But what's the takeaway here? If you look at everything, right now, you would want to buy uh, by demand that's, above 5 and continuing to move higher. Well, there's only one candidate right now that would fit that criteria. Or you would want to, potentially buy something that's made its all the way to 10, that being Meta. I mentioned in this morning's note, one of the issues with Meta is it's recently had, short volume that's moved a little bit above trend. I think that's part of the reason why, share price has started to falter just a little bit. But just a reminder, you can scan things fairly rapidly, and if you're looking at big tech, why is it suffering right now? You sort it by the demand trend. There's not a lot to go on. You can see that Netflix topped at 4.2. Nvidia, its most recent cycle, topped at 7. It didn't make it all the way up. Amazon has topped at 8. And you can see that we have three that are moving down. Obviously, Microsoft has been under a tremendous amount of pressure. So is AMD, and we have Shopify that's down at 1 out of 10. So just a reminder what you can do just with the demand trend itself. I didn't look at this ahead of this call. I just thought of it now when I saw it. But let's take a quick look at Amazon. And what's the setup? And maybe I'll do it up here. It'll be a little easier to see. What's the setup for Amazon going into earnings? Obviously, everybody's been doing really, it's been really difficult for big tech. Let's call it, from a pricing perspective, choppy, right? Obviously, we don't want to rely just on price. What is demand or sentiment been doing here in green? Well, it's topped. We had a decent move higher, but it didn't make it all the way to 10. Down below here, we're getting some short covering. So I would call this a mixed setup going into earnings. It's okay demand, and it's good short volume. What would happen in this atmosphere is if you get good demand tomorrow with tomorrow's trading, you would really move higher in Amazon. Why is that? There's limited supply of Amazon out there with the short volume read. So kind of a mixed setup going into earnings, but pretty strong if we get any type of demand that materializes afterwards. Let me stop sharing for a second, see if any additional questions come in. We were looking at that market breadth question. Hopefully, Brad, that addressed some of that. I'll go ahead and share my screen again before I forget to go back to that. Wanted to touch on one topic, and we don't do this topic very often, and I don't update the data very often. Here's what it is. So you can tell I don't update the data very often because this goes back to 2023. The exercise is one in which what happens when the market moves below neutral. If you look at our setup right now, we're very, very close to neutral. I think we move below it. I don't know for sure. We're just doing kind of that uneasy dance right now, at the neutral line. So if we do move below it, this is about 6 years of data. What tends to happen below that neutral period. And for perspective, when you're moving below neutral, you're also approaching a buying opportunity. The buying opportunity is here at the green line. That's when we move below 4 out of 10 from a sentiment perspective. So just kind of keep that in mind. So that being said, what tends to happen if we do move below it? Well, I would say most of the losses actually occur kind of right in this area between 4 and 5. The market starts to deteriorate a little bit like we've been seeing right now. We move below neutral, perhaps like what we saw back in April, and then we start to get some losses in the broad market. When we move much lower than that, the market tends to recover. If the market falls off a cliff, well, we have just a really bad period, because it has fallen off because it's fallen off a cliff. So once again, if I were to summarize, what this looks like, most of those market losses to me do occur between 4 and 5. We don't get down here very, very often. The market does tend to bounce when we move below 4. That's that green line on market structure sentiment. And once again, if we do fall apart, it gets very ugly for a period of time. So just be aware of that. We do have an opportunity when we get below the green line. The market does rally, but even like what we saw back in April, we had moved below the green line. It took a little while for the market to recover. So just be aware of that. If we move below the green line, it's not instantaneous. Occasionally it is, but more often than not, it's not that way. I throw this out here. I have no idea if we're, going to move into a bear market or whatever. We're obviously nowhere close to that right now. But here's a couple of data points. This was at the beginning of the pandemic. If we get just terrible news out there, and where the market's moving rapidly lower, it's just ugly. There's no getting around it. That period at the beginning of the pandemic, it was awful. Just there's no other way to describe that. What if we're in a little bit of a bear market that's not kind of as bad as the pandemic? This is what that generally looks like. And, perhaps one of the takeaways, if you're in a bear market, it's hard to hide. Uh, Sentiment was actually, or returns were actually down 17% when sentiment was above 5 during that period. So, just a really good, lesson there. You really have to move lower in a bear market to, really get gains. And otherwise, once again, it's a very difficult place to hide at all. We stop for a second and let's go see if any questions have come in. Question from Candace, 0 days to expiration options. 1.5 trillion in daily hedging flows. As someone holding momentum trades for 3 to 5 days, should we be paying attention to this, or does it mostly just create intraday noise that washes out by the time we're checking edge signals? It's a great question. It does create just a lot of intraday noise. Uh, what is happening behind the scenes, though, is if you're getting this deterioration over time, you have someone or someones that continue to lose money, right? And then you have to think about what is potentially happening to some of their positions. Are they going to be at risk of margin calls or what have you? So we're getting this slow kind of trickle lower right now, but we do have to be aware of what's happening in the background. Our principle of, those holding those trades for 3 to 5 days, it absolutely holds true. We see that in the percentage of time that it works, but we also have to be aware of what's occurring in the background at this particular time. And we're getting that slow trickle lower. And I'm wondering if we're entering into a little bit of a risk off atmosphere. Anesh, are the daily ideas also updated? Let's go take a look at that. I don't know. I just saw that some of the data had been updated. Let's see. How would I know that? Anesh, it does look like they have been updated because this has data through 2.5. And if we look at the total numbers there, 20 names, still a lot to choose from. Uh, low volatility, 5 names. Part of the reason that low volatility starts to get lower in terms of overall names, it becomes very difficult. I believe our criteria is 2.2%. It becomes very difficult to find stocks that have volatility under 2.2% because we're starting to see in the background that overall volatility is increasing, and as a result, low volatility just becomes very difficult to come by. Let's go take a peek at the model portfolios just to give you an update in regards to that. You're looking at the edge focus momentum. Had a very difficult day last Friday. I think we had a silver play in there that did not do well, and that whole space has come under a lot of pressure. I did mention it in last Friday's note. There's a risk when you come to month end, and I'll talk through what I was mentioning in that note. Let's pretend like this was a silver stock going into the month end time frame. And let's pretend in your portfolio you wanted to hold a 5% weighting in silver and gold. And at the end of the month, your portfolio, you had an 8% weighting in silver and gold. Well, what's going to happen? Unless the criteria change or unless there's flexibility in terms of making adjustments, at some point, some selling has to occur to bring it back down to the overall weighting. So there's always that risk, especially at context events in the marketplace. We were at one here, when we saw that severe decline. This has not been updated yet, so this is through 2-3, getting just a little bit of outperformance relative to the broad market, about 2.8 on focus momentum versus this a couple of days ago, about 90 basis points in the broad market. Let's take a look at low volatility. Here's what low volatility has been doing, heavily slanted towards big cap, towards big tech, excuse me, just by virtue of some of the criteria in terms of the holdings and overall performance. Once again, through 2 days ago, 1.5% versus 90 basis points. Candace had asked a question. Great question. I don't know if I know the complete answer to it. She had asked why we get the swapping back and forth sometimes, and you can see it here. So a couple of days ago, we went into GOOG. We exited out of GOOGL. Why is it doing that? And by the way, if you're in the portfolio and you see exiting out of one and entering into the other, if you're in one of those names, I would just hold on to it and don't buy one and sell the other. That would be my recommendation. But why it's doing that, this is the criteria for the portfolio, and I think it's going into the exit criteria with that supply demand divergence. I think that's feeding into the exit, and then I think it's feeding into the opposite side of it as well. So hopefully that addresses that question. Let me see if we have any additional questions. Anesh, yes, we do need to update the model portfolios. I don't know if I will have time before the close to do so today. So what we might get tomorrow, you might see two days there in terms of what's happening with those models. John had a question under the daily trading ideas. Walk me through one of those names, NET. What can I gather from this entry? Sounds great. Let's do that. Let me share my screen. Okay, so daily trading ideas, and sorry, I don't know if it was in the momentum. Okay, NET. So the way that you can think about this, and I will tell you guys this over and over again. These are momentum names, and they're momentum names for a reason. This was a great example back on the 30th. This name was still in there. It came under a lot of pressure afterwards. How can it do that? Because its daily volatility is almost 14%. So just be aware of that daily volatility and be comfortable that, if the market's getting jumpy, I don't know if that's a term or not, but if the market is showing high volatility, that volatility can come out of it, the other way as well. In terms of NET, what this is showing us, movement between lows and highs right now is 7.6%. The entry low is about 164. The entry high is about 175. So we don't want to chase it above 175. And this entry low, what that is telling us, and it's communicated here, the entry range is down 50% to up 30% of volatility. So that's where that number is coming from. So if we look at the trading today, then the range between 164 and 174, and let's go take a look at that. 164 to 174. It's trading, right down at the bottom end of that potential range. Good opportunity. If I pick up names, I tend to do so in the last 10 to 15 minutes of the trading day, but that's well within its range. As long as there is no news in this particular name, and this is not going to provide everything here, but this is just one way to look at news. As long as there's no news, as long as earnings isn't coming up in the next couple of days, then that would certainly fit the criteria for moving into that position. Um, just personally here for a little while, I'm probably going to avoid the momentum names for a period. Why is that? There's a lot of rolling crashes, as Tim mentioned a couple of days ago. There's just a lot of potential, canaries out there in the coal mine. There's a lot of canaries that are out there, and I don't know what happens. Are we moving into that risk off atmosphere? Um, we're just gonna have to wait and see. Brad, uh, good observation from Brad. I'm learning that the model portfolios don't filter out for earnings. Focus Momentum went long Amazon, but today Amazon is down 4%. Will the model just close it, or will it wait for it to come back? Brad, that depends whether it hits the exit criteria or not. So yes, Tim and I will try to pick out those names. If they're coming up, we won't always be successful, but that's a good observation, and that is something to be aware of. The models itself don't they hold those names, through earnings, as you can tell. It's both good and bad. Potentially there can be downside pressure if it's a bad period. Last year we saw the upside potential, that can come with that, with our low volatility, returning like 60% during the course of the year. Going back to net for a second, it looks like demand is falling and supply is neutral. Yeah, let's go back to that and take a peek. And thanks for the questions, everyone. I appreciate them. And great observation. And that's similar to what I was talking about with big tech earlier. All things being equal, I would rather be buying something that has demand that's continuing to move higher, or it's up at 10 and it's topped at 10. I would rather not be picking up something where demand is actually moving lower right now. It still meets our entry criteria, but all things being equal, I'd rather buy increasing demand and not decreasing demand. Let's see. Anesh is making an observation. Daily trading ideas seems the same as yesterday. And that could be the case. I haven't had a chance to verify that, everyone. I just noticed that the data was starting to update as we were in the middle of this meeting. Let me go ahead and move to our kind of our section ahead, and then we'll circle back and see if there's any last minute questions. If we look at what's ahead, I think for me, part of it has to circle back to what we were talking about here at the beginning of this call. I don't expect this type of downside. What I'm pointing at is back in April with the tariff tumult. But, we had a rapid deterioration below five, both in terms of big tech and both in terms of the broad market. Right now we're doing that, and I'll call it a dance. We're doing that dance with sentiment just right around five. What that tends to produce in the market, it tends to produce very choppy trading conditions. I was looking at a financial services firm just ahead of this uh, session, and for about 3 weeks, they would move a little higher, they would move a little lower, up, down, up, down. That's the environment that we're in right now with sentiment kind of tied to five. We'll see what it is after today's trading, but that becomes a little bit of a risk for me when sentiment is doing this uneasy dance right around neutral. Um, I think that's the biggest point for me. I want to see if sentiment stabilizes. And once again, if it doesn't stabilize from a big picture perspective, I'll show you what happens once again to broad market returns. We tend to lose most of our broad market returns between 4 and 5. And then when we move below 4 from a sentiment perspective, that's when it becomes a buying opportunity. Once again, if the market really deteriorates, it does get ugly. So just be aware of that. But from a big picture perspective, this is our buying opportunity here at the green line, which is sentiment of a 4 out of 10. Candice gave us an update that her daily trading ideas had updated and getting a little bit of a rally in Google. Any other questions from anyone here before we close today's session? It looks like John might be typing one last note. Um, yeah, John, we're thrilled to have you here. Great questions. Is there a pre-built scan to ID stocks that have rising demand and falling supply? Well, that's what our momentum portfolio does, John. That is hitting that uh, sentiment rising. What you can also do, John, is you can build model. I was going to say model portfolios. You can build what's called dynamic portfolios. So you can then put the criteria in there, like, hey, I want demand that is. And sorry, guys, I tend to do this when I start talking. Let me share my screen. So I'm here under dynamic portfolios, and then you can enter whatever criteria you want. So you want demand, for instance, that is moving greater, and you want it moving greater than six, or whatever that criteria is. And you just go through those different things, and you can slice and dice however you want to. You can have certain sectors in there. You can have short volume only moving in a certain direction. So, John, if you have questions about how to set up these dynamic portfolios, please feel free to send me an email and I can help you with that. Guys, with that, thank you for your time today. It's always a pleasure. Hope you have a great rest of the day, and we will do this again next week. Take care, everyone. And we will stop the recording.